If you own a home in Canada and your mortgage is coming up for renewal this year, you're probably about to receive a letter in the mail that looks kind of like this. Now, the banks call this your renewal offer. I call it the auto sign trap. They're betting on exactly one thing: that you're too busy, too stressed, or too intimidated to ask questions. And they're betting you're just going to sign this and take whatever they offer for convenience. But in today's rate environment, that signature is likely to cost you upwards of $15,000 in interest over the next 5 years of your mortgage. So today I'm going to show you the 3 tricks hiding in that letter and why the easier option is actually the most dangerous one. So let's tear this bad boy up and get into it. Let's be honest, banks are businesses. Their goal is profit margins. They're in the industry of lending money to make money, and they're incredibly good at it. When they send you an auto renewal letter 4, 3, 6 months out from your mortgage renewal, they aren't offering you their best rates. They're offering you an easiest rate. We'll call this the lazy tax, for lack of a better term. They offer you a small discount off their posted rate, which is artificially high, I might add, so it looks like a better deal to you. But because you don't shop around, you don't realize that the market rate is actually significantly lower than what they're offering you. Now, 0.5% doesn't sound like much until you do the math and realize on, a $500,000 mortgage, that half a percentage is roughly $200 a month and can cost you about $12,000 over the course of 5 years. Would you voluntarily write a check for $12,000 just to avoid a 10-minute phone call? Because that's effectively what you're doing when you just sign the letter and send it back to the bank. Now, maybe you don't want to switch lenders, but then you hit trap number 2, the collateral charge handcuffs. Many standard banks, such as RBC, CIBC, Bank of Montreal, pretty much any of the chartered banks aside from Scotiabank, register their mortgages as a collateral charge on your title. This makes it harder to perform a simple switch, moving to other lenders for better products, and it really eliminates the ability to have what's called a no-fee switch, where that new lender is going to cover your legal fees and appraisal costs. Essentially, it limits your ability to move based on the assumption that you're not willing to pay $1,000 to leave your existing lender. So they don't have to be competitive. Now, here's the secret. If a new lender wants your business bad enough and you have a standard charge on title, as previously mentioned, they're going to cover your legal fees and appraisal costs to move over, so long as you keep your balance the same and your amortization the same. It's called a no-fee switch. We do them all the time, and they're super easy to do, but it does require that you don't have that collateral charge on title. And the other aspect of this is offering products like this up front and having a full understanding behind them. Because signing a mortgage to get a, 0.1 or 0.2 off your mortgage rate and registering a collateral charge can create a lot of issues. The only time you should have a collateral charge on your mortgage is if you have a readvanceable mortgage with a home equity line of credit attached to it. If it's a standard mortgage, you have no need to have a collateral charge. And if you see that on there, you should ask questions about why it's on there. Because another little secret, some of these banks will register for a collateral charge for 100 to 110% of the value of your house, severely limiting your ability to make changes in the future. Now, the final trap is subtle. To soften the blow of higher rates, some banks will offer to extend your amortization back up to 25 or 30 years to keep your payments lower. It feels like relief, but in actuality, sometimes it isn't. It's a blindfold. By extending that timeline, you're adding years of interest to your payments, to your life. You are essentially renting your house back from the bank for longer. Don't accept an extended amortization without looking at the total interest costs first and all the numbers involving that. And then, of course, shopping around and comparing against the market, because as rates come down, so does your payment. And if you are going to take an extended amortization, because let's not kid ourselves, sometimes you need that and sometimes it can be relief. If you need that, ask the bank what they're going to do and how they're going to advise you to get you back on track to paying your mortgage off on time, instead of just by extending it and leaving it as is. So the letter's arrived, you see the rate, you hate it, and you have 2 choices. One is the hard way. You pick up the phone, you call the number on the letter, and you fight tooth and nail to try and get a better rate and a better product. And you're going to want to tell them, in quotes, I've seen better rates and received better rate offers elsewhere. And if you can't match or beat them, I'm going to need directions on how to get a payout statement ordered for when I replace your mortgage. Now, be warned, the person on the other end of the phone is a trained retention specialist. That's their entire job. Their entire job is to keep you signed without having to drop the rate too much or to the actual bottom or floor of it. It's a negotiation. If you enjoy haggling, by all means, go for it, and I wish you the best. But then there's option 2. You let us be the bad guys for you. Instead of fighting for one bank's best rate, you can have my team shop your renewal against 50 different lenders all at once. We know exactly where the floor on the market is right now, and we know which lenders cover those costs and transfer fees and things like that, and how to avoid costly mistakes such as collateral charges or bona fide sales clauses. If you have a renewal letter sitting on your counter, don't sign it. Click the link in the description and book a time with my team. We'll review that offer and tell you immediately if it's a good offer or if it's a ripoff, and show you the math on what you could be saving elsewhere if there's better options available. We'll also take a scan through it to make sure you don't have things like a bona fide sales clause, collateral charge, or any negative clauses or high penalty clauses for if you ever wanted to make changes in the future. It costs you nothing to check, but signing the wrong paper could cost you thousands. So don't pay the lazy tax. And if you want to understand why rates are moving the way they are and what it could mean for renewal payments and all that sort of stuff, watch this video right over here on Payment Shock Next. I'm Myles Nowik of the Nowik Mortgage Team. And remember, your renewal offer that you first get in the mail, well, it's not because you're their friend. It's because you're their client and they're trying to make money off you. We'll see you on the next one.